Hey friends, my name is Yi and you're watching Yi Makes It Easy. And welcome to a new video for IGCSE Business Studies, and today we have 4.2 for cost, scale of production and break-even analysis. And by the end of the lesson you should be able to describe 4.2.1, identify and classify costs, 4.2.2 economies and diseconomies of scale, and 4.2.3 the break-even analysis. So check out the pinned comment for all the timestamps. But we'll move on now to 4.2.1, identify and classify costs. And here's business costs. All business activities involve costs of some sort, and these costs cannot be ignored. For example, the manager of a business is planning to open a new factory making sports shoes. And why does the manager need to think about the costs? And some of the reasons are explained below. Number one, the cost of operating a factory can be compared with the revenue from the sale of the sports shoes to calculate whether or not the business will make a profit or loss. Number two, the cost of two different locations for the new factory can be compared. And number three, to help the manager decide what price should be charged for a pair of sports shoes. And accurate cost information is therefore very, very important for managers. Then I have fixed costs and variable costs. And fixed costs are costs which do not vary in the short run with the number of items sold or produced, and they have to be paid whether the business is making any sales or not. And they are also known as overhead costs. And variable costs are costs which vary directly with the number of items sold or produced. And in calculating the cost of the business, it's important to understand the difference between the different types of costs. And the main types of costs are fixed costs and variable costs, right here on top and on my right. And examples of fixed costs include management salaries and rent paid for property. And even if the output was zero, as I mentioned, you will still have to pay it. And examples of variable costs include materials costs and piece rate labor costs. And the more units that they produce, the higher these variable costs will be. Then we have the total cost and average cost. Total costs are fixed and variable costs combined, and the average cost per unit is the total cost of production divided by the total output, sometimes referred to as unit cost. And the total cost of a business during a period of time are all fixed costs and added to all variable costs of production. This total figure that can then be compared with the sales revenue for the period to calculate the profit or loss made. And an average cost per unit can be calculated from the total cost figure. An average cost is the total cost of production divided by the total output. And for like a sports shoe manufacturer, producing 30,000 pairs of shoes each year, this could be calculated as follow. We have like the total cost of production, 150,000 equals fixed cost plus total variable costs, which are 50,000 and 100,000 each, for example. And for stage 2, the average cost of production, which is the total cost of production in the time period, divided by the total output in the time period, and they have to be the same time period. And let's say we have the total cost of production right here, 150,000 divided by the total output, 30,000 pairs of shoes each year. It means it's $5 per pair. And if both the average cost of production and the level of output is known, the total cost can be calculated by multiplying average cost per unit by the output. The total cost equals average cost per unit times output. Then we have to use cost data to help make simple cost-based decision, and using cost data. And once a business has classified all costs into either fixed or variable, this information can be used to help make business decisions. And here are 3 examples. Use of cost data, setting prices, deciding whether to stop production or continue, and deciding on the best location. Let's say for setting prices, the average cost, you want to make profit here, cost-based pricing. And the explanation for it is that if the average cost per unit is not known, the business could charge a price that leads to a loss being made on each item sold. And for deciding whether to stop or to continue the production, For example, the example includes if the total annual cost of producing a product is 25,000, but the total revenue is only 23,000, then the business is making a loss and could decide to stop making the product. And the explanation include no business wants to continue to make a loss, but the decision to stop making the product will also depend on whether the product has just been launched to the market, and the fixed costs will still have to be paid. And for the deciding on the best location, examples include the location for A for a new shop has a total annual cost of 24,000, and location B has 15,000 annual cost. And on this data alone, location A should be chosen. But in reality, there will be more things that go into the deciding on the location, maybe closer to the CBD or the central business district, or the outskirts of the city, or transportation links. And costs are not only the only factor that is considered. There might be let's say location to decide, or choosing a low cost location for a new shop. Then we have 4.2.2 economics and diseconomies of scale. So here we have the concept of economies of scale with examples. So here's economies of scale. Economies of scale are the factors that lead to a reduction in average cost of a business increase in size. And there are 5 economies of scale. Number 1, purchasing economies. When businesses buy large numbers of components and they are able to gain discounts for buying in bulk. Number 2, the marketing economies. There are several advantages for a large business when marketing its products, including being able to purchase its own vehicles to distribute goods rather than depending on other firms. And transport costs will be reduced using larger vehicles. Number 3, financial economies. Larger businesses are often able to raise capital more cheaply than smaller ones, and bank managers often consider that lending to large organizations is less risky than lending to smaller ones, and the lower rate of interest is therefore often charged. Number 4, managerial economies. Small businesses cannot usually afford to pay for a specialist manager like a marketing manager. This tends to reduce their efficiency, and large companies can afford specialists, and this increases their efficiency and helps to reduce their average costs. And then we have technical economies. And there are many of these, but here are some few examples. Transport costs can be cut by a large amount when using larger ships and vehicles, and large manufacturing firms often use flow production methods. And these apply the principle of the division of labor, and the use of flow production and the latest equipment will reduce the average cost for the large manufacturing businesses. And in addition, some machinery is only made with a certain high output capacity. For example, automatic welding machine can do 100 welds at a time or a minute. And a small firm, if bought such a machine, couldn't keep the machine working all day, and the average cost of using it would be high. And this is because the machinery is not divisible into smaller capacity machines. And then we have diseconomies of scale. And diseconomies of scale are the factors that lead to an increase in average cost of business as the business grows beyond a certain size. And is it possible for a business to become so large that it becomes less and less effective? Is there a limit to economies of scale? And some research actually suggests that very large businesses may become less efficient than the smaller ones, and this could lead to higher average costs for big firms. And this could occur because of certain diseconomies of scale. And it includes number 1, poor communication. The larger the organization, the more difficult it becomes to send and receive accurate messages. If there is a slow or inaccurate communication, then serious mistakes can occur which lead to lower efficiency and higher average costs. And this relates to my first few videos on section 1 of the chain of command and the company structure, whether it's tall or short, or a long chain of command or a short chain of command. Number 2, the lack of commitment from employees. Large businesses can employ thousands of workers, and it is possible that one worker will never see the top manager of the business, and workers may feel that they are unimportant and not valued by the management. And in small firms, it is possible to establish close relationships between workers and top managers. And the lack of these relationships in a large business can lead to a lack of commitment, low efficiency among the workers, and this will tend to push up average costs. And number 3, the weak coordination. And it often takes longer for the decision to be made by managers to reach all parts of large business and different groups of workers. This can make it too difficult to coordinate the work and decisions of all parts of the business and ensure that they are working towards the same objectives. Employees could also take a long time to react to managerial decisions, like once it has been taken, and it is very difficult to prove that these economies exist in practice. However, many very large businesses are now breaking themselves up into smaller units, which can control themselves and communicate more effectively. And this trend is aimed at preventing diseconomies of scale that reduce efficiency and raise average costs. Then we have economies of diseconomies of scale, like a diagram to show. Like for economies of scale, these lower the average costs, like purchasing, marketing, financial, managerial, and technical, which is good. And this economies of scale is a bad one, which raises the average costs due to poor communication, slower decision making, and lack of commitment from employees. Then we have 4.2.3, break-even analysis. And here's the concept of break-even. Break-even is a very important idea for any business, especially a newly set up business. And the break-even level of output or sales indicate to the owner or manager of a business the minimum level of output that must be sold so that the total costs are covered. And at this break-even level of output, it is important to note that a profit is not being made, but neither is a loss. And the quicker a newly set up business can reach break-even point, the more likely it is to survive and go on to make profit. And if a business never reaches the break-even point, then it will always make a loss. And the break-even level of output can be worked out in two ways: by drawing a break-even graph or chart, and by calculations. And here we have drawing a break-even chart. And in order to draw a break-even chart, we need information about the fixed costs, variable costs, and the revenue of a business. For example, in the sports shoe business, we will assume that the fixed costs are $5,000 per year. The variable cost of each pair of shoes are like $3. Each pair of shoes is sold for a price of $8. And the factory can produce a maximum output of 2,000 pairs of shoes per year. So here we have the break-even chart. We have this, the y-axis and the x-axis. The x-axis is the units of production. And the y-axis is the cost and revenue. And we have this blue line, or the green line, if you call it, whatever. And it's the variable cost, and it's constantly changing. And the more you sell, the higher it is, because variable cost is affected by the output of the sales. And this horizontal black line over here is the fixed cost, and it will not change because it's fixed cost. And this red line over here is the total cost. This purple line over here is the sales revenue. And you can see when the point of the total cost and the sales revenue crosses each other, you can see if let's say in this case it's a 1,000 unit production, and this point right here is the break-even point. And the break-even chart shows fixed costs, variable costs, as I mentioned, fixed costs, variable costs, total cost, revenue, and profit, and the break-even point. And the point where the break-even point where the total cost and revenue crosses, to the left of it, it's the area of loss. And to the right of it is the area of profit, and this part right here is the profit. And here's the break-even formula. We have the break-even unit equals the fixed cost over the SP minus VC, whereby SP stands for selling price per unit, and VC equals variable cost per unit. And here's the table right here. And when the output is 2,000 units, the variable cost will be 2,000 times $3. From here, the variable cost 2,000 times the variable cost $3 equals $6,000. And assuming all output is sold, the total revenue will be 2,000 times $8, because you can have maximum pair of shoe per year, 2,000 pairs. And the sell price, the selling price is $8, $16,000. And make sure you understand how other figures will arrive before looking at how the data is used to construct a break-even graph. So like this line right here, as I mentioned, the sales revenue, total sales revenue 16,000, and the total variable cost 6,000. And you can see how the relationship between all of the factors. And here's break-even chart again, and it's a typo here. We can plot the information on the graph, and as I mentioned, the y-axis measured the money amount, cost, and revenue, and the x-axis shows the number of units produced and sold, and the fixed costs do not change at any level of output, and the total cost line is addition of variable costs and fixed costs. And what does the graph show? The break-even point of production is where the total cost and total revenue cross, and the business both must therefore sell 1,000 pairs of shoes in order to avoid making a loss. Because it crosses here, you can see 1,000 pairs, and right here. And then production below the break-even point, the business is making a loss, and at production above the break-even point, it makes a profit, and the maximum profit is made where the maximum output is reached, and this is a profit level of 5,000. Because you can see 16,000, which is the sales revenue, the maximum sales revenue, and the total cost, the maximum total cost is 11,000. 16,000 minus 11,000 is 5,000, so the maximum profit is $5,000. And here's advantages and limitations of break-even graph or break-even charts. Advantages include the managers are able to read off the graph for expected profit or loss to be made at any level of output. And the impact of profit or loss of certain business decisions can also be shown by redrawing the graph. The break-even chart can also be used to show the margin of safety, which is the amount by which sales exceed at the break-even point. And the disadvantage includes the break-even charts are constructed assuming that all goods are produced by the firms are actually sold. The fixed costs only remain constant if the scale of production doesn't change. The break-even charts concentrate on the break-even point of production, but there are many other aspects of production operations of a business which will need to be analyzed by managers, like how to increase sales. And lastly, the simple charts used in this section have assumed that the cost and revenue can be drawn in a straight line. And lastly, here's some definitions for 4.2, cost, scale of production, and break-even analysis. And here we have fixed costs. And fixed costs are costs which do not vary in the short run with the number of items sold or produced, and they have to be paid whether the business is making any sales or not, and they are also known as overhead costs. The variable costs are costs which vary directly with the number of items sold or produced. The total costs are fixed and variable costs combined. The average cost per unit is the total cost of production divided by the total output, sometimes referred to as the unit cost. The economies of scale are the factors that lead to a reduction in average cost as business increase in size. The diseconomies of scale are the factors that lead to an increase in average cost as a business grows beyond a certain size. Like we have reduction and increase. The break-even level of output is a quantity that must be produced or sold for a total revenue to equal total cost, also known as a break-even point. The break-even charts or break-even graphs show how cost and revenue of a business change with sales, and they show the level of sales the business must make in order to break even. And the revenue of the business is the income during a period of time from the sale of goods and service. And total revenue is equal to quantity sold by the price times by the price. And the break-even point is the level of sales at which total cost equals total revenue. The margin of safety is the amount by which sales exceed the break-even point. And lastly, contribution. The contribution of a product is a typo, a product. The contribution of a product is its selling price less its variable cost, which is the contribution. And that's it for this video for 4.2 of IGCSE Business Studies 1 today. we'll look into the second lesson of session 4 for 4.2, cost, scale, production, and break-even analysis. And I hope you guys found it useful and found it helpful. And if you did, please leave a like and subscribe, and don't forget to ring the notification bell and hit the subscribe and like down below. And comment if you have any questions or criticisms as well. And check out my Instagram in the description for more daily content. And don't forget to hit the subscribe and notification bell. And I hope you guys found it useful and helpful, and I'll see you guys in the next video. Until then, stay safe and happy learning.